Yeah, so good evening. Thank you for joining us this Thursday. So, welcome to Real Estate Accredited. Hopefully, we're able to provide you some value of educational material that maybe you can use as a tool in your toolbox, whether you're investing in real estate or thinking about participating in real estate deals. We welcome any and all questions. In order to keep it productive, we pretty much create an outline, a topic of discussion. But if we need to deviate from that, and have questions, feel free. But that's how we're going to roll with it. Philip, take it away.
Thank you, Jeff. Yeah, as usual, we'll do maybe 25 minutes, 20 minutes of a little bit of a educational side to this call, and we will follow up by just doing some networking. We're a small group. We'll be able to have a good discussion. After that, we just launched a few weeks ago. So we're trying to build our audience. So thank you for joining us. Today, Rajiv is not with us. He's busy with his W-2, talking about financial freedom with real estate. So, he's missing out. All right. So today we'll talk about underwriting and risk mitigation of a real estate investment. And as usual, our starting point, our baseline is in-place commercial multifamily value add. So let's get that. I don't have that many slides, but so what's the secret underwriting rule? It's not that secret. I think it's almost common sense once you've done it a few times. Number one, like you're going to use assumptions to start doing your underwriting, and then you just have to make sure that these assumptions are correct. So check and recheck. That's how you'll be able to be successful in this business. And we're going to dive actually in the different areas of underwriting and so let's take it from there. So first, you want to take a look at the purchase price, and we want to make sure that whatever you're going to buy, at least, let's say at maximum, is in line with sales comparable. So other sales of similar vintage, similar size, renovation level, similar amenities as well. You want to make sure that you're paying a price that is in line with that, or ideally under that, but certainly you don't want to pay over that. So that's the first thing that you want to consider. Income. I think there are two sides of income. There's going to be the target rents, vacancy, etc. For comparable rents, at a high level, you can use tools like Rentometer, or actually Bigger Pockets Pro, I should have written here, or apartments.com, even better. You'll be able to figure out the rent comparables, but then you want to check this information with the property manager that is going to manage the property, because just to get an opinion, like for them to confirm you have the proper comps, maybe there's some factors, if you don't know necessarily the sub-market, that they may have a better understanding of. And you also want to check with reports from company like CoStar or Yardi. Those reports will be available from the broker typically. Sometimes the reports, you have to take them with a grain of salt, at least on the rents. But I think vacancy, another forecast, like I'm showing on the right side here, this is coming from a CoStar report. I think I think they have teams of economists doing research, and I think it's a good starting point, at least, to use a vacancy projection, and as well as rent increase forecast. And finally, you want to really double check the rent comps by doing an in-person tour of the other properties. That's very important, again, just to confirm everything that you've done as a first round, even second round, everything is lining up, because you don't want, now you're doing due diligence and they are giving concessions across the street. So that would be worrying for me. And as you can see, for instance, and as for a sub-market of Atlanta here, as for Decatur, the expectations for Atlanta and actually and the sub-market is to have 0 or minus something over the next 2-3 years. Actually, it's 2 here after it's turning around. Income growth, that's a parameter you want to take a look at from like years 2, 3, 4, etc. What kind of growth can you expect? Obviously, that's a good chart here. In year 2021, 2022, at least to some extent, there was double-digit growth. But if you look at historically, that's not the norm, right? So you want to make sure you're using the right numbers on the income growth. And again, actually, I started to talk about that earlier, but you want to check whatever, let's say your default is inflation between 2 and 3%, which is like historically for over many years inflation number. But then you would check with the CoStar report, for instance, and look at the forecast and apply, maybe do a little bit of a correction and lower the numbers. Interestingly enough, on that particular deal, I pulled the CoStar report from when I spoke to the property manager. He was observing a tremendous growth in that particular submarket. So he was saying he didn't believe at all in the negative growth coming in the future. So I think what I ended up doing is just lowering my growth maybe to 1.5% or something like that, trying to go between the PM and the report, for instance. It's just as an illustration. As my recheck step here, I think obviously any major local economic development will have an influence, right? If there's a company that is coming who is going to open a factory, or for instance, talking about Atlanta, there was Microsoft was supposed to build a campus like in the center west of the city. So that was, at the time, it was certainly a big positive factor for growth in that area, except after layoffs earlier this year in the tech industry, including in Microsoft, they said, we're putting that on a pause for now. So, it's another thing, like any major economic development, if they didn't break ground, yeah, it's a positive factor. I wouldn't take it into account in the underwriting, personally. Don't hesitate if you have any question or comments.
One addition to that is, since the competition of rent is actually home ownership, looking at the home ownership price point on the average cost of a acquisition in that market. So the average cost of a property, apply the interest rate to what it's going to cost to live at that property. Some people may be holding off until the interest rates go down. That's always a good factor to look at, because if housing is not affordable, they're going to rent. They're going to turn to renting until the interest rates are in more favorable range. So that's always something to consider. That's just the competition, for lack of a better term, of rents like this.
Yes, indeed. Good point. Next, expenses. So, and don't pay attention to this chart. I just pulled something to have a nice illustration. Don't take notes. Controllable expenses, those is general and administration, marketing, maintenance, turns, services, payroll, and management fee. So usually once you've underwritten a few properties, you're going to have some numbers that you can reuse. for that given market and type of property and so on. And that's what I'm saying here by use assumptions. If you don't have that, I would say skip this point and directly talk to a property manager if you plan to have third-party management. If you were to manage by yourself, now it's an interesting situation. Usually we do larger properties, so always have property management. And I think it's very important, and it makes a lot of sense to have professional management just from a cost of running business and level of professionalism, etc. So whatever assumption you use, check with the property manager. And then I would say eventually you want to ask them to commit to the numbers. I would ask them for a pro forma, and with the intention that's going to be your budget for operations. So I could say pro forma or budget, it's the same thing. Next, tax and insurance.
Deal breakers many times.
Yes, indeed. So again, you may start on those with assumptions if you have a quote from a prior deal or something like that. It's almost useless in my experience, unless you're underwriting like very often. Those are, especially insurance is changing all the time. So it's better to get a soft quote at least. Tax, depending on, you need to understand how the property will be reassessed. In some, I think in the Carolinas, it's on a fixed schedule, at least South Carolina. It different in Atlanta, it's going to be reassessed on the sale. So you need to understand like the formula they'll use. And if it's going to be a larger deal, you want to talk to a real estate tax lawyer who can do an appeal for you, and then have a discussion with them to understand what to expect. Right, so that's the B here. Check with third party, and then eventually you're going to ask them to whatever they're saying. You want like a hard quote to formalize. Especially insurance is very tricky. You want an actual quote from an insurance company, because the soft quote, typically you'll get it from an insurance broker, and he's going to give you an estimate based on their own numbers that they see and so on. But you definitely want to see a hard quote for finalizing the underwriting.
And just to add to that, remember that the insurance will be based on a lot of factors on the condition of the property. So always a huge issue is properties that have aluminum wire. That's always something to consider, because the insurance might be high, and then the cost of replacing a lot of those connectors with pigtails or things like that can increase prices drastically. So always finding out these type of, which is part of due diligence, which I'm sure Philip's going to cover, but I just want to point out that it has a direct correlation with insurance prices as well.
Yeah, not today though, but at some point we'll cover that. Next, we talk about debt. So about the senior debt, like the number one, the primary loan. In other words, again, steps for underwriting. One, use assumptions. Actually, I believe, like if you want to go with agency debt, Fannie and Freddie, you can use like treasuries plus 2 or 3% to get an idea of the current rate. I think it's once you have, yeah, if you can watch the waiting room, Jeff, just in case there's somebody. Yeah, so you can use a rule of thumb like that, but it's probably better just to have a soft number, I would say, from a loan broker. And then the next step is, from the assumptions, you want to go to have an actual soft quote from a loan broker. So you'll have to give them your underwriting, your assumptions, for them to size the debt on the deal. And finally, again, before once you get close, I would say before you sign the contract, a contract on a property for an acquisition, you want to ask for a hard quote, like a real, like basically a lender application at that point, and there will be a quote in that paperwork because you want to confirm. And actually, I should have written also, you want also to, for how long, ask for how long the rate, the interest rate. I cannot see anything. The interest rate is, yeah, because that was problematic, especially when the rates increased. And I think at the end of the day, even they may say, oh yeah, we're good for 30 days and so on. And if there could be something happen, unless it's written, so you have something in writing, it may not be correct. But if you have, I would say, if you have a good loan broker, they will do what's necessary to guarantee a rate, and they'll honor whatever they committed to. But it is a little bit tricky.
Paula asked about the replace the LIBOR for people that don't know about it.
I didn't miss completely the whole chat. Explain SOFR. I didn't mention Polar SOFR actually on purpose.
You didn't, but you did. You alluded to it, Philippe, because you said this is how you look at the rate, and then you do 2 to 3%, but then you
No, it's on the
test it with 1
treasuries.
to 2%.
It's on the
So
treasuries. Give me 1 minute. Actually, I'll
yeah,
put
I
up
just
my
want people that don't
notes.
know what the hell you're talking about to know what you're talking about. Because there was a time I didn't know what you were talking about, and you taught me, so I know that other people would find value in that.
Fair enough. Let me pull up my notes.
And I'm glad that you're going through this and thinking of stuff that that has come up that you're remembering, because that's very helpful to the newbies like me. Thank you.
So while he pulls that up, the SOFR pretty much replaced LIBOR, which was the London interbank offered rates by the secured overnight financing or financial rates, which is just a new benchmark interest rate calculated differently. On those specific calculations, I'm not 100%. Hopefully, Philippe has a little bit of notes on that, but it changed the dynamics and the calculations for the interest rates. We could probably do a little presentation on that, but it's just the new when you're looking at loans or things from brokers, just make sure it's a SOFR rate that you're getting and you're not looking at a LIBOR rate, because when that change happens, some deals were being analyzed by the old rate calculation and they were missing their benchmark, whether their underwriting was too high or too low, and the deals had made sense with LIBOR, which wasn't being used, and then when calculated with SOFR,
it didn't make sense.
It didn't make sense. So that's very important to
know how they're calculating. That's right.
So this is the note what I was referring to, and I know it was the treasuries, so it wasn't LIBOR. So the assumption, you can use the US 10-year treasury plus 1.5 to 2% spread as an example. So that's for agency debt.
And most of it today is fixed agencies.
Yeah. 2% spread.
We watch the yield curve every day.
So the SOFR is going to come into play. So it's the same formula. So SOFR plus a spread for a variable rate. And now SOFR is pretty much very close to the Fed interest rates. As Fed interest rates go up, SOFR is going to be up as well.
Rise on the cuffs of the benchmark interest rate.
Which it's a good segue to my next point here, because You're going to prefer, and that's what I really recommend, like these days, unless you know what you're doing, or you have a crystal ball, you're going to prefer a fixed interest rate for an acquisition. And if you don't have a fixed interest rate and you have a variable rate, you have to use a rate cap, so which will cap the rate, how far it can go. And that's where on a variable rate, I should say for variable rate. Yeah, so that's where the rate cap will become useful, because the risk, even though, let's say, like the Fed has planned to lower but we don't know how long it's going to take, number one. Number two, there could be another event that will lead to higher interest rates. You just don't know. And that's what really happened to some people that purchased properties in 2021, 2022. Like they went with a variable rate, but if you didn't have a rate cap, now these days you're in trouble, number one. Or if you took a rate cap for only a shorter period of time, you're also in trouble, which actually, with Paula, we were talking about that earlier. It's probable that there will be a lot of opportunities in the coming months and possibly years for distressed assets that cannot pay their debt. And it's a very important thing to consider. If you're buying anything, you have to pay attention to that, to de-risk your acquisition. And we'll come to that in a minute. So the other thing I would say on the same train of thoughts, avoid refi in the initial business plan, because a refinance, you just don't know what the interest rate will be down the road. You don't. But you can make all the assumptions you want. We pull a chart of the interest rates of the 80s. I don't think they were expecting to have interest rates in the 15%, but it happened. Were people expecting that, Paula?
Yeah, I remember 20.5%. That was
There
quite
you go.
young.
There you go. And last, if you're going to exit a loan early in commercial real estate, some of these loans, there will be a prepayment penalty. And I think all of them, at the end of the day, there will be at least a 1% cost if you're exiting early, but it could be much higher depending on what type of exit prepayment penalty there is. So I don't want to go into the weeds about that topic, but you want to have a predefined exit cost to get out of the loan if you're selling earlier than the term of the loan on the property. Looking at the exit, I think good underwriting methodology is to apply a cap rate expansion. For instance, I thought I used that chart a few weeks back, but I think it's a very important chart to understand. So we see it's a plot of the cap rate, historical cap rate in Dallas in blue, United States in orange. And what you want to, if you look at the forecast, so we see there's a turn in the cap rate is going to be a little higher and then decrease. But when you underwrite, you're going to look at, okay, I'm going to hold that property for 5 years and I'm going to expand the market cap rate of 0.1% per year, for instance, in that illustration. And if we base, assuming the forecast is going to be the real, what's going to happen, it's a good move in that case, because you're matching the cap rate expansion. I think what you want to look going forward is assuming that there's an expansion. In other words, there's something adverse happening that is going to lead to prices of real estate to go down, which it's inversely linked to cap rates. So cap rates go up. So the last slide I have is for risk mitigation. As usual, you're going to want to do a stress test. And I think the most important is like how does the property performs at 70% occupancy, for instance? Are you able to cover your debt cost or not? If not, you better have reserves. You can also stress test what are the impacts of the exit cap rate could have on the returns, for instance. So that's another thing. You can do a stress test. There are many flavors of stress test. I think at the end of the day, the most important is basically dimension your reserves based on looking at adverse scenarios, right?
Yeah.
And also the final bullet here is when any renovation budget, you want to add a contingency. I know some people do 5, 10, 15%, so depending on the budget size, but you want to have a little bit of contingency on the renovations. And I would say, yeah, so that's part of reserves. Reserves is operational reserves is, let's say, again, you want to make sure you'll be able to pay the debt. So maybe you want to have X amount of months of principal and interest on the debt in reserves. I know during COVID, the lenders, they were requiring that. These days is not the case, but at some point they were requiring like 6 months of principal and interest to be in escrow at closing, for instance, which obviously lowered the returns. But at the end of the day, it's not bad practice to have reserves. It's really something to take into consideration.
Paulo, your question about the 0.5% cap rate increase per year.
Yeah. Maybe he was just talking about that for Texas for 3 to 5 years, because they were on a panel and they were talking about that.
Okay, and also considering the asset class, that plays a factor as well. Yeah, because that just puts you at 25 basis points on an exit. Most of the properties, B class, C class, can be up to 50 basis points on exit.
0.5 per year. This is huge.
That is huge. It is huge.
That's what he said. 0.5 per year.
I think he was just talking about a specific market.
Oh,
and he was
okay.
talking about a specific time period. So that's okay. I understand.
Yeah,
that
I know
really needs to be checked big time.
In my, if you remember my little table, okay, I could bring it up.
Yeah,
I love your little table, Philippe.
2.5% in 5 years.
Remember, in the past, we've been in a big bubble here in Austin. Big. So it's crazy, the market right now, because we've had a lot of influx of people come here, and now the rents are decreasing. So it's been like this.
Yeah.
This is what I use. I use, but and again, it's just guidelines.
I like it.
But the max I have is if you're above 7% with a class C, you want to expand 0.25 per year held.
Yeah, it's 1.25 points.
Yeah, for 5 years. Yeah. Otherwise, if you're below 5 in class B, you go at 0.1. But again, what does that mean? It's just, this is a model. It's like everything else, because if you go back to this,
yes, it is.
you're buying at the wrong time.
Well, we're all about to be buying at the right time.
Yeah. So anybody who bought there, they're not, if they don't have a problem with the debt, they're going to hold the property for little longer to achieve returns.
You have to write it out.
Yeah, exactly.
You're going to have to hold it longer, I think, right? Because then that way, otherwise you don't.
Otherwise,
your IRR will be pulled out, but You'll still be able
won't,
to
yeah.
make some money after you keep it long enough. Hopefully,
Exactly.
hopefully.
Might have to do capital calls too, just to hold it.
They talked about that. There were some people in the audience that said, yeah, we did have capital calls. Who wants to admit that? It's just
Part of
part
it.
of it, part of it. To me, Philippe, that last thing you mentioned about renovation budget, based on what your assumptions are and what you can make, you really, as compared to what other properties bring your competition, and depending on the market too, if it's a luxury market, then you got to make sure your property looks comparable for the rents. And maybe we can't do all the renovations we wanted to do. We got to do the ones that make the property look as good as it can. Preserve
And
that
yeah, and again, that's
to make some decisions.
it makes a lot of sense to align with the competition, but sometimes it makes sense to do a little less. Sometimes it makes sense to do better. I think it goes back to what can be done is, in my opinion, it's a factor of, talking to the property manager who is managing similar properties in the area and because the no risk is you stay in line, right? So if you do better, you can try, but maybe people will not move there because that's not the area that is calling for luxury interior or something like that, right? And if you do lower, let's say much lower, or you keep it like unrenovated, maybe in the long term it's going to suffer too, because now you're not in line with the market, and your target renters, they are going to expect something else. It's sometimes, especially, I would say, I always like to all my students, and Paula knows that, I'm like, you don't want to take a chance and be the first. So especially when you begin, like, just when you begin, just follow what the other properties are doing. That's why don't go in a tiny market of 20,000 people. That's taking a big chance. You don't want to be the mayor of the city, because when you own all the real estate, you better know what you're doing.
Oh yeah, professional tenants abound, right?
Yeah. So now, if you just follow, when you begin, you just follow what the others are doing, stay in line, and find like the little thing that they overlooked. And so now you're taking less risks.
Yes,
That's the best
sadly.
way to do it, to start, I think.
Yeah, and don't go undercapitalized, that's for damn sure. Sheesh, look what's happened to a lot of people.
Yeah, the struggle is real and it's out there right now.
Yeah, it's gonna get worse. It's gonna get worse next couple months. We'll see.
Yep.
Yeah.
If does anybody have any other questions or anything off topic that they'd like to share, ask? Chris, thanks for joining us. I don't think we have the opportunity to meet you yet, but if you have any questions or anything, like I said, off topic, or anything you're working on and you'd like to share, please on mic and let's have a chat.
Yeah,
Hey.
I put my information in the chat already, so you guys need to do the same, so we'll know who you are, please.
Oh, I'll do that right now.
Thank you.
Of course.
And what you're interested in? What do you like to invest in?
We're doing, oh, I'm sorry, I hit enter and it,
It's all right. Just to let you guys know, I had a dinner with an attorney about a week ago, and she was encouraging me to invest with their people. I just want to give you some hope and inspiration. 3 years ago, I took her to dinner and she had 19 syndications. And today I took her to dinner and she has 60.
wow.
So she's an attorney and she's well capitalized. And she said, the secret is to don't invest so much at once. You'll have 62.
Is she active or passive?
Oh, she's very passive.
Mm.
But she's also very well capitalized, and she and her husband's a
Well, again, I'm
forensic
sure.
IT professional. So he's one of those guys that he's always looking around the room. What are you looking at? So I'm noticing something. And I'm like, oh, geez, thinks like a criminal. It's very scary. But it's very funny that it's 3 years is all it took. So
Good for her.
yeah,
Excellent.
good for us.
Yeah.
Good for us.
Yeah.
Yeah, we got lots of connections with those investors, and the sky's the limit, and real estate is on sale.
It's getting there. It's getting there.
Yeah,
There's still a little
it's getting
nostalgia.
there.
There's
It's-
still a
it's-
little nostalgia out there of sellers still wanting those 2020, 2021 prices. But
There's a lot of good GPs that are really hurting right now, and there's a lot of people that might lose hundreds of thousands of dollars of investment. And that's what I learned at that old Capitol meeting. And it's real. It is real. The Fed is going to increase probably, so we all need to be aware. Get ready, strap in.
yeah, we'll see. We're coming to election, so there might be a surprise. Who knows?
I think that surprises Jeff is going to come before the elections,
Oh,
right?
yeah, absolutely. Yeah.
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 Carlin, you're working at something right now?
I was just gonna share an experience and
Yes,
maybe
please.
maybe pick your brains on possibly why you think this seller did this. But so my team and I were sent a property that had 100 units. And when our underwriter was digging through the OM, we discovered that they had renovated every single unit. And there was just no meat left on the bone.
Mhm.
So I blew my cover. So what I mean by cover is, and I did it on purpose, but what I mean by cover is because I'm exiting the film industry and I was just thinking about, okay, what do I want to do? Maybe I'll dabble in property management until I figure out what my next career is going to be. And I'm temping as a leasing agent just to get into these properties, excuse me, and see just the ins and outs of how things work and things like that. And the interesting coincidence was I was staffed at this property when our underwriter received the OM for that same property that I was staffed at. So that was an amazing coincidence. And so I met the owner who also happens to be acting as the regional. So she said she's one of the owners. And so I told her, I said, at the risk of blowing my cover, like, and I told her about us and I said, why would you guys, like, why did you all renovate all of the units? And she said, for more money. I was like, okay. I said, our strategy is value add. And I was just curious as to why you did that. And she said, we flip apartment complexes. That's what we do. And I was like, huh. I didn't know how to take that.
Mhm.
I didn't know if I believed it. You know what I mean?
But did you ask her to who she's selling in general? Because that's the key.
I didn't
Who's-
ask her that, but this property had 100 units. It was in Forest Park, Georgia, which Clayton County, because I'm the one in our team that's doing the market research. Clayton County is not really ideal for us as we dug into it. We bounced around with Clayton County, but it seems like we're leaning more towards no. So I didn't ask her that, and I still can. I've got her number and I'll be at the property tomorrow.
Yeah, ask her, because I think, and that's part of when you think about your exit strategy, you want to know who is a buyer for this size property. And let's say like a big, now you have BlackRock
Institutional investment.
who is going, they just want to buy something and let it cash flow. That's their approach. They're not going to do value add necessarily. It's going to be minimal. So
Felipe, are you saying they're going to decrease operating expenses in order to make it cash flow, or just let it go as
no, if it's obviously, so now you have a problem between the cap rate and the debt. So that's a little bit a problem right now.
Oh, but also if it's institutional investor, if they have capital from their investors, then they can pay all cash, then they don't have to really worry about the and all that. So it's like Philip said, it depends on who their end buyer is. So if they're looking at cash strapped buyer that doesn't have to worry about all these other things, and appreciation and want some cash flow for their investors because they have to put their money somewhere, that's probably their focus. That's probably their buyer.
Is that why they built the platform yesterday for the tokenization for the GPs? Y'all heard about that? Maybe because everyone gets a little bitty share of the GP, like a
No,
decimal
I don't.
point?
Yeah. Oh, BlackRock is doing that.
They're doing it with JP Morgan Chase. They announced
There
yesterday.
you go.
It's a portal.
Who knows? Who knows? Yeah,
Well,
that's
because that
their.
would mean that they're just getting a little bit of whatever
Yeah,
rent. You know what I'm saying? They're
yeah.
just getting a little bit because they needed someone to
But
fund
then
the
so
debt because no one's lending, and that way they
yeah,
already own a lot of their property. Come on,
yeah.
what they said.
So obviously, Carlin, I think the people to whom you're
Huh.
talking, their strategy is not to sell it to syndication groups like us, who is doing to do value add to make the syndication work, and for the GPs to make sweat equity. So
Yeah.
that's impossible. So that's why for me, that's a filter I have when I look at an OM. If I see all the units have been renovated and I look at the pro forma from the broker compared to the current NOI, if there's like a few percent increase, that doesn't work. You need to have a huge margin to make it work, really.
Yeah. They're
So-
basically selling to people with deep pockets.
Philippe, isn't Lifestyles the other group that's buys without? I mean, they keep it. They just keep it. Because I've been on tours with them before and they said, look, we don't sell in 3 to 5 years. We just keep the property. Why are you selling? It's just a different
Well,
strategy.
it depends. Are you selling? So again, if you do a syndication value add and you look at the
Value add,
numbers,
yes.
I think you're going to make 60%, around 40 to 60% of the returns. It's at disposition.
Yes.
If you don't sell, then you do a refi, the return profile is going to be very different. So now the only way it would work in that case is if you do a cash out refi and then just you can distribute 70, 80%, 90%, 100% of the equity, people will go along with you. But if you say, okay, no, I'm going to do 2x, and when you do a refi, you only give them just like 50% of their investment, and they're doing like poorly on cash, because by the way, when you refi, your cash on cash is going to be proportionally higher. The amount will be less. And I say proportionally higher because your cash basis is going to be much, much lower. But it's a very different profile. It's a very different profile. And I think at some point that made sense, but I think these days it's pretty hard to make it work.
I just think it's interesting. I don't think a lot of people understand that. And I'm glad we're talking about it because a lot of things are going to perhaps make people keep properties a little bit longer in the future than they would normally keep them. And so that's a good class to go over. We discuss value add because that's what we do. And we look for that 85% maybe renovated and the 15% that's not, what we call meat on the bone, but not everybody does that.
Yeah, and at the same time, and I think maybe 5 years, it's not a very long time, because you can argue like things that were renovated 5 years ago, they're still going to be pretty current. But sometimes there are other things that can be added as well. But it's a real question for sure. Or the exit is an important, and I know, for instance, think multifamily, they always go with 80% of the units to be renovated, always.
80, I've seen 80 and 85 and that's it.
Yeah.
Yeah. Even 90's pushing it. Harlan, are you in what are you in Atlanta?
I'm in Atlanta.
Atlanta. How far is that city from where you are?
About a 20 to 25-minute drive, depending on
traffic. Right there. You could be checking that property out. Okay.
Oh, I checked it out. Like I said, I'm staffed there right now. And they did a really good job on the renovations, like shaker style cabinets. They didn't just resurface them or anything. All new cabinets.
Wow.
It has LVP flooring. What's that popular shade of gray that
Agreeable gray,
I think that's what it's called. They
Yeah.
have that on the walls.
Ron Williams.
And it's
Yeah.
stainless steel appliances, not white appliances, not black.
Wow,
all
not black.
stainless steel.
Mm.
Yeah. So they did a
Yeah.
really good job, and I just trying to wrap my head around that. But what Philippe said makes a lot of sense. Maybe they're just selling to someone looking to
No,
improve.
because if they know the people who buy, and they can, because especially what's interesting in that particular example, when you think about like institutional money, they're going to look for, like I said, like stable. Usually they don't worry, they don't spend time with 100 unit. They look for much larger.
Much bigger.
So it's interesting. It's
Yeah.
interesting. And again, different, some, I don't know. Yeah, it's
They just announced yesterday that they're building a portal. So we might want to just in a couple months take a look at what they offer on their website and see where their direction is. I can bet it's just they want to go to tokenization for little bits and pieces of ownership. So that's the digital world we live in.
I remember discussions about that. The limit to that is that if you don't have a marketplace, then your token is just a nice fancy technology,
Fancy piece
and
of digit.
it doesn't help necessarily.
I agree with you. But it's a risk. It's a risk.
Yeah, I guess if you buy and nobody buy, yeah, if you buy, nobody buys from you, yeah, that's a risk.
Yes, that's a risk.
You're gonna be in a pickle.
Well, maybe they're just thinking of owning it forever and then taking what they can off and working on expenses. Maybe they're thinking they're going to keep it for a longer period of time. Who knows? Who knows what their goals are? So very interesting now. So, Carlin, are you doing this 40 to 150 units in Georgia? It says pitch roofs and value add, etc. Is that a different property?
No, I was just laying out my criteria, what I was looking for.
What you're looking for? Okay.
And we've only done the market research in Georgia so far. I'm open to other states, but haven't really dove into the research in other states and to see what anything looks like.
I've heard Atlanta's good. Have y'all heard
You're
that?
in a good market, so
Yeah.
There's a property I'm looking at right now. It's just shy of our criteria, so I'm gonna have some conversations because the team I'm currently with is too small for us, but it's 34 units and they're selling that as well. And it's in Atlanta, but the area is not that great in Atlanta. So there are parts of Atlanta that are great. There are parts of Atlanta that are not so great. We can certainly have a further conversation about it.
Is that because of crime? When you say
Crime.
it's not a good, yeah, it's
Crime.
crime.
In fact,
No, I wouldn't do that.
right. In fact, two of the units were vandalized and are vacant because of that. No, I'm sorry, they were vacant prior and then they were vandalized. But when I look at the area, because I was staffed at another property close to there as well. There was another property that had just been renovated. It's also less than 3 miles from Chick-fil-A, Publix, Starbucks. So I'm torn. I'm torn. I don't know. 34 units still needs to be renovated. But the crime piece it's alarming.
I would stay away from any place with crime because the crime is going to get worse, right? As the inflation goes up, then it's more risk of that. If you've already got it,
I don't know. I'm still thinking about it.
well, you might want to look to see what this city has in place. Maybe there's movement, maybe there's money that's going to be invested.
Yeah.
So you might be able to get ahead of it if it's like a 2-year plan for them and
Yeah.
you know the opportunity now. That's where you find opportunity where people are now looking for things like that, city plans.
look who showed up.
Consider.
Adriana, thank you for joining us, but we're about to wrap this up actually.
Okay,
It's
she's
7
been on a
p.m.
plane all
Eastern.
day. That's my partner, Adriana. Adriana, how you doing?
I'm at the airport.
That's
Oh,
right.
okay.
We're
Thank you
just
for
talking about
joining. Saying
we're just
hello.
talking about LIBOR, and we're talking about value add, and we're talking about people selling property without putting any meat on the bone. So what is that all about, right? They're not doing value add, so.
No, that's a very good question,
Yes,
actually.
yes.
Yeah, let
yes,
us know,
very good.
Carlin, please.
Yeah, oh, I wanted to say this too about that one property. The real deterrent for me, if I'm being honest, is the fact that they take housing vouchers in Section 8. That's the real deterrent. Exactly. Yeah.
I
Now
wouldn't do it. I
now
would run. I would run.
Now the crime
Because I've dealt with it before, and it's
the crime piece can change once you see all of the work that they're doing. I think it
you
can
end
go-
up visiting the property and there's police notices on the door, and I took down a couple of shrines to the devil and red paint everywhere, and oh my gosh, I've been through it all. No, thank you. If you have a choice, hello.
Crime is worrying because what are you going to say to your investors? Where anybody was going to do a little bit of research.
Yeah.
And that's for me, that's taking a chance. I'm not.
It's bad enough you
This
take a
is
chance
not
for yourself, but
something-
for an investor, I don't think so. I'm not going to do that.
Yeah. All right, Jeff.
All right.
Wrapping this up.
Yeah.
Thank you,
So
guys.
yeah, thank you for joining us. And if you have any other ideas or any things that you'd like to go over on one of these.
Yeah. Any topics in the future? Shoot us an email.
Let's talk about the interest rates and financing. The
I
SOFR
had a
change.
lender come on like a few weeks ago.
Really? We're going to need
Did
to
you
talk about
attend?
what's
Did
going
you
to happen.
attend?
I tell you what, Philippe, I'm going to send you Neil Bawa's talk, and then you
Yeah.
research it, and I'll try to get the audio from Julie, and then we'll talk, okay?
Sure, we'll do that.
Okay.
Let's do that.
All right, God bless
All right.
everyone.
That's good.
Bye con Dios.
All right, thank
Good
you.
day.
Thank you everyone
Good
for joining.
Bye, everyone.